everybody, Chris from Fluent Mortgage. Breaking news. All right, as we know, the Federal Reserve just spoke literally Friday. And then yesterday, Monday, an announcement. I'm going to let you watch it. I'm going to sort of react to it afterwards. Again, we already know the Federal Reserve reacted. They said due to inflation, they're going to raise rates 2%. Well, they said 1.9. It has to be 2%. 2%, right? But then yesterday, listen to what they had to say.
The ultimate responsibility for price stability rests with the Federal Reserve. Price stability is essential if we're going to have another sustained period of strong labor market conditions. I believe that the policy approach that I've laid out is well suited to achieving this outcome. We will take the necessary steps to ensure a return to price stability. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
Wow.
Our monetary policy framework emphasizes that having longer-term inflation expectations anchored at our longer-term objective of 2% helps us achieve both of our dual mandate objectives. While we cannot measure longer-term expectations directly, we monitor a variety of survey and market-based indicators. In the recent period, short-term inflation expectations have, of course, risen with inflation, but longer-run expectations remain well anchored in their historical ranges. The added near-term upward pressure from the invasion of Ukraine on inflation from energy, food, and other commodities comes at a time of already too high inflation.
That's true, but
in normal times, when employment and inflation are close to our objectives, monetary policy would look through a brief burst of inflation associated with commodity price shocks. However, the risk is rising that an extended period of high inflation could push longer-term expectations uncomfortably higher, which underscores the need for the committee to move expeditiously.
It's not oil. Okay, so what did we learn? What was said, right? Okay, first off, on Friday, we already knew. We jumped rates 0.25%. We did the market Monday on it, and they're going to say 2% more, right? But remember, just yesterday, we're like, hey, here's what's not in there. Here's what's not in there, right? When they spoke on Friday, we already knew about the oil, right? We already knew about Russia and Ukraine. We already know, and just so in case you know, the oil we get from Russia is only 6 to 8%. So if we're seeing more than a 6 to 8% lift in our prices, it's other factors on the oil, right? So that set aside, why would the Federal Reserve, already knowing we're at inflation on Friday, what information could have been in that last few days to make them literally say, not just 2%, we might start doubling that. So literally we could see 3 to 4% jump by year's end. Probably 0.5% when they meet next, right? Every meeting is a live meeting. We expect to see rates go up. We told you yesterday. Unfortunately, when you write a check for $1.5 trillion, it's going to cause hyperinflation. That wasn't priced into the 2%. I'm shocked. We said it literally just yesterday that this day was going to come. I'm shocked that literally one day later, basically, they came out and said, just kidding, on the 2%, it's going to be 3 or 4. So, okay. So that's for sure on the table. One thing that's interesting, though, and you know how we always like to talk about stuff that nobody's talking about, what could come down the pipe, and really what to watch a little bit. So, oil, okay? Again, only 6 to 8% from Russia, and we're looking to refill that 6 to 8% from Saudi Arabia or Venezuela. I know most are trying to push away from Venezuela for, and I won't get into that. That's politics, right? The problem, though, is Saudi Arabia. So this is going to be very interesting. Major source of oil for us, right? They're talking to China at the same time. And Saudi Arabia is talking about moving away from the dollar to the Chinese yen. So if that happens, that gives you a very clear insight into where their alignment's going to be, who is their primary focus, and if we're going to rely on Saudi Arabia for our oil, how things could either become easier or rougher in the going future depending on how they're dealing with China. So again, no matter what, we know we're going to go 3%, 4% probably based on future inflation, minimum 2%. But the Fed's already told us they're going to jump it almost double. So that's the why.